Well, the Property Investor Show is buzzing with the news from yesterday that the judicial review will not be going ahead into Section 24. And somebody whose opinion we always value at Property Tribes is Stephen Johnson, MD of Shawbrook Bank. And Stephen, obviously yesterday, disappointing to say the least.
Yeah, it is a shame, and it's a disappointing outcome just because we know the impact it has on many landlords and ultimately what it can do to rents and what it can do to tenants. So yeah, disappointing that the guys have not had a chance to sort of progress that. But I think it's just really important now that we focus on awareness, making sure that the landlord community out there really does understand the cash flow implications of the tax relief changes, are planning for them, and are making the adjustments that they need to make sure they manage that position. And I guess also we have had a change of government since the summer. We got a lot of different people in the policy teams in housing, and so I guess with the autumn statement coming up, we'd be interested to see whether there may be a slight different tack possibly taken from government and its approach, maybe slightly more supportive of the private rented sector. I don't know. So I guess we can see whether there might be a slight different change in tone maybe from the government now it's a new government.
Well, it's certainly very uncertain times for landlords. What do you think landlords can do to create some feeling of certainty for the long term? Are you seeing a lot of landlords interested in fixed rate products, for instance?
I think there's a variety of things that landlords can do and are choosing to do. I think the most important thing, though, is for a landlord to look at their own portfolio and to work out, under the changes to the tax relief, what their actual cash position is. And they need to do that first, because then that sort of helps them quantify the size of their, some of them may find that they're less profitable, some may find they're loss-making. And I think it does depend on where you sit, and that will depend on the yield that your properties have. It will depend on how much debt you've got in your portfolio. So I think the first step is a landlord must do their own homework and look at what it means for them. And then you can decide whether it's looking at the rents that you're passing on, whether you can start to filter through some of the increased costs in rents, whether people tries to maybe deleverage, maybe sell some parts of their portfolio that are less, that have got more of a drag on them from an income point of view, whether they think about maybe converting some of their properties into sort of multi-units in some ways to increase the yield, whether they look at other costs in their business, whether they look at refinancing some old debt that might be more expensive that they could maybe replace cheaper. I think there's a variety of levers that a landlord can pull, but I think until you know the gap, your cash problem, you can't really figure out what the right strategy is. So that's what I would encourage people to do. We've done our own analysis on the clients that we've lent to over the last 5-6 years, and we can identify those that are higher risk, and we're writing to those to say that we've kind of done some own analysis. It looks like you might be most exposed to the changes. Want to make sure you're aware of them, that you're thinking about them, and that you're deciding what to do to try to to be able to absorb the increase in costs, really. Because people may decide not to invest some money in certain things. They may decide that they need to save some of their earnings from other parts of their businesses to kind of compensate. But I do worry that not everyone really understands it yet, fully understands it, and from next year that it starts happening. So it's not this long thing in the distance. It's kind of very much here and now.
Well, it's very interesting to hear that you're actually writing to clients and looking to support them. That's fantastic. But do you think we, as a wider community, have a responsibility to try and create this awareness to the 97% of the landlord demographic, which are the small landlords with 3 or less properties that probably don't even have this on their radar? Do you feel that we as a community should be stepping up to the plate and really shouting about this to get them engaged in the topic?
Yeah, I think so. I mean, it's hard to say that we shouldn't. And I think you come to events like the property show today. There's a lot of every conference I've done for ever since it's been announced, everyone's talking about it and trying to raise awareness, showing simple illustrations of how the economics have changed for landlords. But yeah, I mean, because one of the elements of this tax change, which is particularly unfair, is its retrospective nature.
Yeah.
And we absolutely have a duty to try and do all we can to educate landlords. And I do have just a worry that it'll only become real for people when they get their tax return and they get their accountant saying, here's your tax liability, and it looks very different to what they're expecting. So yeah, we absolutely do have a duty to do that, as well as maintain the momentum, hopefully the engagement with government to try to get them to reflect on this. And obviously the work that the judicial review guys have done has highlighted where some of the analysis seems slightly flawed in its introduction. There's obviously there's evidence of this being done in Ireland where it wasn't successful. So we obviously need to maintain that momentum and that dialogue with the government as well, and seeing whether we can assist the landlords and assist the tenants who will ultimately be paying the price.
Just to finish, Stephen, we've had on Property Tribes some research that says that there's been a massive increase in landlords looking at buy-to-let in a limited company format, limited company mortgages. Is this reflected in what's happening at Shawbrook? Are you getting a lot more inquiries about limited company mortgages?
We've always been very heavily weighted to sort of corporate landlords anyway, because of the proposition we have and focus on the professional lender community, landlord community. So we've always been quite heavily weighted that way anyway. A slight shift, but not a massive shift because of our historical positioning. What I think will accelerate that shift is the underwriting standards that have just been published by the PRA, which I'm sure has had some airtime. But one of the consequences of those new underwriting standards is that it will mean that limited companies will be able to gear slightly higher than individuals, have a lower coverage ratio because of the interest tax relief available to them currently at the moment. So I think that will accelerate that kind of activity probably more to limited companies. But there's a whole range of factors that landlords must think about. It's kind of income tax is one element, but you've got capital gains tax. It's more favourable individually than it is in a limited company by and large if you're selling assets. So if you're going to be selling some properties in the near term, actually incorporating is going to probably be inefficient for you. Inheritance tax, many landlords are actually building up this wealth for future generations, and in a company there's opportunities to do things with shares in trusts that's good for future estate planning. So and running a corporate landlord, different access to different finance products, different costs, different administrative costs to run a company. So it's not straightforward, and ultimately landlords must get specialist advice, be clear about what their own strategy is, and then choose the best route based upon their strategy, rather than just thinking, well, all roads must lead one way or the other.